Confused about how much you will have to pay in case you sell your property in Canada? Do you need a basic explanation about this topic? Then you're in the right place. Welcome to today's video, where we dive deep into one of the crucial aspects of real estate transactions in Canada, capital gains tax. Whether you're a homeowner, investor, or simply curious about the tax implications of selling property in Canada, this video will cover everything you need to know. I'm Aguinaga, your Montreal real estate expert. If you're new to my channel, welcome. If you're returning, welcome back. Please make sure you like and subscribe. It's going to motivate me to continue putting out this content for you. So let's get started with the most basic question. What is the capital gains tax rate on real estate in Canada? In Canada, capital gains tax is applied to the profit earned from selling a property that has increased in value since its purchase. The capital gains tax rate depends on various factors, including your residency status and the type of property sold. For a few more months, Canadian residents can expect to have 50% of the capital gains be taxable at your marginal tax rate. Non-residents are subject to a different tax rate on capital gains from Canadian real estate. Now, how do you calculate capital gains? Calculating capital gains on property sale involves several steps. First, determining the property's adjusted cost base, or its ACB, which includes the property purchase price, certain acquisition costs, and any eligible capital improvements. Next, subtract the ACB from the sale price to find the capital gain. Finally, apply the capital gains tax rate to the taxable portion of the gain to calculate the tax payable. One of the questions that will probably come to your mind is it possible to avoid paying capital gains tax? While it's challenging to completely avoid capital gains tax on real estate in Canada, there are strategies to minimize its impact. One option is to use the principal residence exemption if the property qualifies as your principal residence. Other strategies include using tax-deferred accounts like a registered retirement savings plan, an RRSP, or a tax-free savings account, a TFSA, for certain real estate transactions. The 2024 federal budget was released mid-April. It included $52.9 billion in new spending plans, which will result in a projected deficit of $39.8 billion this fiscal year before gradually declining to $20 billion by 2028-2029. Many of the budget's commitments are focused on easing the affordability challenges facing young Canadians, particularly when it comes to achieving home ownership. Conversely, many of the new tax announcements are aimed at wealthier Canadians. One of the new measures released last month was the increase to the capital gains inclusion rate. This applies to annual gains above $250,000 for individuals and to all gains for corporations and trusts. The new inclusion rate rises from 50% to 66.7% for dispositions on or after June 25th, 2024, including sales of non-principal residences such as vacation homes or investment properties. The budget reaffirmed that sales of principal residences will remain fully exempt from tax on capital gains. Here's an example of the new capital gains inclusion rate on the sale of a non-principal residence property. Let's say you own an investment property that you originally bought for $200,000 and you sell it for $550,000. The profit you made from the sale is $350,000, assuming no capital expenditures, etc. Under the previous tax rules, you would include 50% of your $350,000 gain in your taxable income for the year. That means that you would pay taxes on $175,000 of the profit at your marginal tax rate, roughly $87,500. With the new tax rules, the capital gains inclusion rate has increased to 66.7%. This means you now have to include 66.7% for annual gains above $250,000 if you're an individual. This means you still include 50% of the first $250,000, i.e. $125,000, and 66.7% of your next $100,000 gains, which is $66,700, for a total gain in your taxable income of $191,700. You would pay roughly $95,850 in taxes on this new gain. When we compare the current taxes to the new taxes, we see an increase of $8,350 in this example. Not a huge difference given the size of these figures, but hey, I'd much rather that money be in my account than the government's. Real estate capital gains tax in Canada is a significant aspect of property transactions, and understanding its nuances is crucial for making informed financial decisions. By grasping the tax rates, calculation methods, strategies for tax reduction, and practical examples, you're better equipped to navigate the complexities of real estate taxation in Canada. I hope you found this video informative. If you have any questions, let me know in the comments down below. Or if you would like to dive deeper on this topic, don't hesitate and book a call with me. You can find my calendar link in the description. Don't forget to like this video and subscribe to my channel for more fascinating discussions on real estate. Thank you so much for watching.